Renee and Desmond are sitting at their kitchen table on a Tuesday night, and there's an envelope between them that neither one wants to open. It isn't a bill. It's from their mortgage servicer, and the subject line reads Annual Escrow Account Disclosure Statement, which is the most boring arrangement of words in the English language, and also the reason they're about to have the worst conversation of their marriage. Desmond opens it. Their payment just went up $307 a month. Not their rent, not an adjustable rate. Their 30-year fixed mortgage, the one their loan officer kept calling locked in. They didn't refinance, they didn't miss a payment, they didn't sign a single new document, nobody even called them. The interest rate on that loan is exactly what it was the day they closed, down to the decimal, and it will still be that number in the year 2056. The rate is locked in. The payment is not. My name is Nick, and I've spent an unreasonable amount of my life reading mortgage paperwork nobody is supposed to actually read. If you own a home or you're saving to, hit subscribe and drop a like, because today we're taking apart the trap that gets almost everybody. And I want to flag one thing now that we'll come back to at the end. There was a single line on Renee and Desmond's closing paperwork that predicted this exact night. They saw it, they initialed next to it, nobody explained what it meant. Let's start with the uncomfortable part, which is that none of this was really a mistake. Here's the thing about how houses get sold in America. You don't buy a house. I know it feels like you buy a house. You tour it, you love it, you argue about it in the car on the way home, but at the moment you actually decide the thing being sold to you is not a house, and it isn't even a price, it's a monthly number. Every participant in that transaction has worked out that you decide on one figure, and that figure is your payment. So your payment is what they engineer, basically down to the dollar. And I don't mean that in a conspiratorial way, I mean it in a documented, publicly reported, said out loud on an earnings call way. DR, Horton is the largest home builder in the country. In their fiscal fourth quarter of 2025, about 73% of their buyers got a mortgage rate buydown. 73%. That is not a promotion, that is the business model. Their communications executive told investors they were leaning in harder on advertising a 3.99% rate, and that the average rate sitting in their backlog had dropped below 5%. Meanwhile, their gross margin on those homes fell to roughly 20%, down from nearly 27% a few years earlier. Read that again because it's the whole game in two numbers. They spent enormous amounts of their own profit to lower your payment. They did not lower your price. That isn't sloppiness, it's precision. Cutting your sticker price by $40,000 torches the appraised value of every other house in that development. Spending $30,000 buying down your rate moves your monthly number the same distance without ever touching the comp. You feel relief. Your neighbors keep their valuation. The only casualty is your understanding of what you just agreed to. So you sign, feeling responsible because the payment fit. And here's what nobody warns you about. The payment you qualify for is not the payment you're going to make, not because anybody lied to you, because of what's inside it. Let's put real numbers on Renee and Desmond, and I want to be clear that these two did nothing you wouldn't have done. They're 40 and 38. Combined household income of $94,400, right around the national median for first-time buyers. They waited. They saved. They put 10% down, which today is somehow above average for a first-time buyer. They bought at $412,000 below the national median existing home price. Put 10% down on that, and you're handing over $1,200, which leaves you a loan of $370,800. At 6.66% on a 30-year fixed, your principal and interest lands at $2,383 a month. That's the number they focused on. That's the number the calculator on the listing site shows you. And it's a real number. Yours will never change either. Now add everything that calculator quietly skipped. Your property taxes escrowed at $342 a month. Your homeowner's insurance, $198. And because they put down 10% instead of 20%, private mortgage insurance, $170. That's the fee you pay for the crime of not already being rich. It insures your lender. If you default, it pays your lender, you buy it. Congratulations, added up, and the actual payment is $3,092 a month. Welcome to home ownership. Run their gross monthly income and you get about 7,867, so they're at 39% before a single other bill. But you don't spend gross, nobody does. After taxes, they're bringing home near $5,979 a month, which means your house is eating 52% of the money that actually shows up. They noticed. They adjusted the way people do. They cut streaming services and started planning meals, and honestly, they were handling it. Then the letter came. Here's the mechanism, and I really want you to understand this one because it isn't an accident and it happens to almost everybody. When you close, your servicer estimates your escrow using the taxes the previous owner was paying on an assessment from years earlier, which is a bit like budgeting your grocery bill off somebody else's receipt. Then the county reassessed the property at the price Renee and Desmond had just very publicly paid for it. Your tax bill goes from $4,100 a year to $5,350. Your insurance renews 25% higher from $2,370 to $2,960. So your escrow account comes up $1,840 short, and now your servicer does two things at once, which is the part that breaks people. It raises your ongoing monthly collection to the new correct level, then it spreads the whole across your next 12 payments. So you pay the increase, and you repay the increase in the same month. Technically, that's one payment. It does not feel like one payment. That's the $307. Their payment is now $3,399, which is 57% of their take-home. Locked in, remember, and if you're thinking Renee and Desmond just got unlucky, they didn't, and neither will you. Analysis from Cotality found as many as 65% of homeowners are carrying an escrow shortage, averaging around $2,157. Escrow amounts nationally are up roughly 45% since 2019, so if yours hasn't moved yet, it's queued. Their chief economist said it about as plainly as it can be said. People think of a 30-year fixed-rate mortgage and think of housing costs as fixed. Your rate is the buckle. Your payment is the whole car. And insurance is doing most of the damage. According to ICE Mortgage Technology, average property insurance for mortgage holders climbed to nearly $2,370 a year, about 9.6% of the average monthly mortgage payment. Highest share ever recorded. Over 5 years, your insurance cost jumped roughly 70%, while the principal portion rose 23%. And in about 1 out of every 10 markets in this country, the escrow piece of the payment is now bigger than principal and interest combined. You are, in those markets, paying more to keep the house than to buy it. I'll be careful here because this is where a lot of videos get sloppy. Nationally, the GAO found premiums roughly tracked inflation through 2024. The catastrophe is concentrated. Coastal Carolina, Texas, Florida, California, some areas up more than 50% in real terms. So if you live anywhere with wind, water, or wildfire, the national average is lying to you in the comfortable direction. An average is a very reassuring thing to drown in. Now let me bring in Priya because there's a version of this trap that's worse, and it's the one people choose specifically because it looks safer. Priya is 34, single income, and she did the thing you're supposed to do. She looked at $400,000 houses, decided the maintenance would eat her alive, and bought a 2-bedroom condo for $268,000. Principal and interest $1,550. Homeowners Association dues $385. She budgeted all of it, she was fine, then her building got inspected. Post Surfside, Florida, and a growing list of other places now require structural inspections and fully funded reserves. Reserve waivers are gone, and reserve waiver is basically the polite term for 30 years of agreeing not to think about the roof. So buildings that had been quietly underfunding themselves since the 90s suddenly had to look at the number. Turns out the roof had been keeping score. Her dues went from $385 to $610. That's an extra $2,700 a year, and you'll notice she didn't vote on any of it. Then the special assessment landed, $41,000 for her unit. Financed over 5 years, that's another $831 a month. And if you own a condo anywhere, this is your warning shot. Roughly 40% of Florida condo owners have faced a special assessment in the last 3 years. Some Miami-Dade buildings have issued assessments north of $100,000 a unit, and in a few cases approaching $400,000. Priya can't sell either, because buyers now ask about reserve studies and lenders now care about the answer. And here's what should make you angry rather than scared. Priya wasn't irresponsible. Priya was the opposite. She bought less house than she qualified for, in a building with a pool she barely uses, precisely so nothing could surprise her. Which is, honestly, more diligence than most of us manage. The structure she picked to protect herself was the one that had been deferring maintenance for 3 decades and calling it affordability. Her dues were locked in too. By the way, I opened a school community where I break this kind of thing down in more detail and share how I think about building income outside a paycheck, which matters more now than it used to. Links below, come say hi. Okay, so the payment moves. Painful, but survivable. Here's the part that decides whether any of it was worth it, and almost nobody runs it. You're not just making a payment, you're supposedly buying equity. That's the whole justification. It's why you tolerated the escrow letter. And it's why everyone in your life tells you renting is throwing money away. So look at what you actually buy in year 1 using Renee and Desmond's loan. They paid $28,594 in principal and interest over 12 months. Of your money, $4,020 went to principal, 14%. $24,574 went to interest. That isn't a fee and it isn't a penalty, it's just amortization. Your interest gets charged on your outstanding balance, and in year 1, your outstanding balance is basically the entire loan. You're renting money, and your bank collects the rent up front. So when does your payment start working for you? On that loan, the month your principal portion finally exceeds your interest portion is month 236, year 19.7. You will be closer to your second mortgage than your first before most of your own money starts landing on your side of the table. Priya's version is worse in a way that's easy to miss, and it's the same problem wearing a different hat. Her $41,000 assessment isn't a mortgage, so not $1 of that $831 a month buys her a thing. Technically, she's a homeowner. Functionally, she's making payments on a roof she'll have moved away from before anyone replaces it again. Stretch Renee and Desmond's loan across the full 30 years, and you're looking at about $857,800 paid on a $370,800 loan. $487,000 of that is interest. You pay 131% of the loan in interest on top of the loan. And this is where the 5-year question gets brutal, because you probably won't be there for year 19. Say you have to move. Job, family, whatever, after 5 years, the balance is down to about $347,700. Selling costs, commissions, transfer taxes, concessions run somewhere near 8%. If your house appreciates 3% a year, you walk with about $92,000 against $53,560 in down payment and closing costs. That's a real win. Not spectacular, but real. If it appreciates 0%, you walk with about $31,300. You put in $53,560, 5 years of perfect, on-time payments, and somehow a $22,000 participation trophy. And 0 isn't a fantasy you can dismiss. Cotality reported negative equity rising to about 2.2% of mortgages, roughly 1.24 million homes, up 21% year over year, concentrated almost entirely in recent buyers. In Cape Coral, Florida, something like 70% of the 2023 and 2024 fall vintage is underwater. So let's go back to that line on the closing paperwork. This is the part that annoys me most. On page 2 of the loan estimate, and again on the closing disclosure, there's a box labeled Estimated Taxes, Insurance, and Assessments. Right beside it, in small type, sits a line noting the amount can increase over time. Renee and Desmond initialed it, Priya initialed it, everybody initials it. It's disclosed, it's legally compliant, and it's completely useless because by the time you reach it, you're 11 documents deep, your realtor is checking her watch, and the word estimated has never once in your life meant anything alarming. That's the trap. It isn't hidden. It's disclosed in a way that guarantees you won't process it. Now I want to argue against myself for a minute because a lot of finance content won't, and it makes people distrust the honest parts too. Home ownership genuinely works, and here's why. Forced savings is real, and you are not the exception. Almost nobody who says they'd invest the difference actually invests the difference. That ugly amortization schedule is a savings plan you can't skip on a bad month. Leverage is real. Renee and Desmond control a $412,000 asset with $41,000 of their own money, so modest appreciation throws off an outsized return on your actual cash. And imputed rent is the one nobody talks about. Their principal and interest is frozen at $2,383 for 30 years, while rent on the same house keeps climbing. In year 15, that frozen number stops being a burden and starts being the best deal in their neighborhood. There's also the research everyone quotes, Jord and colleagues. Finding housing and equities both returned roughly 7% real per year over 145 years, with housing far less volatile. Serious paper. I just add the caveat the headlines apparently keep dropping, which is that the housing number is gross, measured before the taxes, insurance, and maintenance you personally pay every year. So sure, housing isn't a bad asset. It's a good asset with a very expensive habit. The thing that decides it for you, as best I can tell, is time. Under 5 years, your transaction costs and front-loaded interest make it genuinely hard to win. Past 7 or 8, forced savings and that frozen payment start doing serious work on your behalf. Median tenure now runs 11 to 12 years, so most owners clear the bar comfortably. The ones who get hurt are the ones who were sure they'd stay and didn't. So who's actually at fault? Because it isn't Renee and Desmond, and it definitely isn't Priya. The honest answer is that nobody in that room is paid to say the word no. Your builder is paid to move inventory, your lender is paid at closing, your agent is paid on the price, and after all the noise about the settlement reshaping commissions, they've barely moved. The system checked itself for damage and, of course, found none. The servicer who mailed that letter didn't set your assessment or your premium. Your county set one. A reinsurance market repricing climate risk set the other. Your insurer is mostly passing along a number that arrived from somewhere far above your zip code. There's no villain standing in the room, there's just a structure where the one number you decide on is the one number nobody is responsible for keeping honest. Which is why it has to be you, so run it yourself before you sign. Take the tax assessment and recalculate it at your purchase price, not the previous owner's. Get a real insurance quote instead of a placeholder, and ask what it did at last renewal. If it's a condo, read the reserve study, and if there isn't one, that is your answer. Then add 15 to 20% to your total escrow and ask whether the payment still works. If it doesn't, you didn't fail a test. You just found the number early in a chair you chose instead of at your kitchen table on a Tuesday. Quick reminder that I'm not a financial advisor and none of this is financial advice. It's math and public data, and your situation has details I can't see from here. And if you're already in it, none of this is a verdict on you. Renee and Desmond are going to be fine. They'll eat the $307, they'll shop their insurance, they'll drop PMI in a few years when they hit 20% equity, same as you would. And somewhere around year 12, that frozen payment is going to start feeling like a superpower. Priya's road is harder and longer, and she'll get there too. Neither of them did anything wrong, they just believed a phrase. If you want more of this, the school community is linked below, and there are people in there working through these exact numbers right now. Here's what I'd leave you with. We've been trained to ask one question when we buy a house, which is whether we can afford the payment. It's the wrong question, because there's an assumption buried inside it, which is that the payment is a fixed object sitting still. The better question is whether you can afford this payment when it's 15% higher in a year you didn't plan for. for a reason that has nothing to do with you. Because that year is coming. It comes for almost everybody. Your rate is locked in, nothing else is. And the only real difference between the people it wrecks and the people it merely irritates is whether they saw it coming.